There are a number of reasons why financial institutions, such as prime brokerages, hedge funds, and asset managers, want to borrow your securities as part of their wider investment strategies. But the overarching reason is market liquidity, and that's beneficial for everyone. It makes your transactions cheaper and saves costs. Short selling is a bet that the value of a stock will go down. Let me give you an example. Let's say you own stock in a car company. You buy it, it sits in your portfolio, and essentially does nothing. Meanwhile, another investor who believes that in the short term, the value will fall. They seek out and borrow your stock, and then they sell it in the market. Let's say, as an example, the value is $200. So they sell it for $200 and receive the revenue. Meanwhile, they're paying you to borrow that stock. Then the value of the stock goes down to $160. They buy back the stock and they return it to you. The entire time, you've kept the value of your stock, you continue to receive your dividends, and you've been paid to borrow. But in the long term, your view is the stock will continue to rise. I'm often asked, why would I facilitate someone short selling a stock that I own? I think that's a far too simplistic way of looking at it. Fundamentally, when you bought the shares you purchased, someone else was selling them. You facilitated them exiting their position. You had different opinions. You wanted to own it, they wanted to sell it. Short selling isn't really any different. Short selling is fundamentally about differing timelines. Some investors believe in looking at the long term, some at the short term. Designated market makers exist within financial institutions and specialist fintech companies. They're different than regular investors. They have to be willing to transact on either side of the market, to buy or sell based upon investors' needs at a moment's notice. However, their institutions don't always have the securities they need. Therefore, they have to borrow the shares in order to deliver them to the buyer. In this way, securities lending acts as a lubrication to the financial market settlement system, ensuring that market makers can continue to trade and provide liquidity to the market, even in times of high volatility. So what's an example that's practical? Think of going on holiday and finding a place to exchange your money. At a given location, the individual may not have the currency that you need when you bring in your dollars or pounds to exchange for a local currency. So they borrow the local currency to deliver to you until someone comes in with a local currency seeking dollars or pounds. What we've done with SLaaS is find a new way to unlock your securities and generate additional revenue while also providing critical market intelligence about what the market is willing to pay to borrow your securities. We have built a network of top-tier prime brokers and developed a tech solution that enables our clients to control not only who they lend to, but how they run their program. It's a truly unique proposition. You get access not only to the legitimacy of our expertise, but also direct access to the biggest borrowers in the world